hello and welcome everyone to today's SRP education event, Financial Planning 101. My name is Sarah Krapak and I'm the Director of Participant Education for Strategic Retirement Partners. And we appreciate you all joining us for the second event of our 2022 education series. A few quick notes before we get started today. All the lines are muted, but we do welcome your questions. Feel free to use the Q&A feature on your screen, and I'll monitor those during our time together and make our best attempt to answer as many questions as possible this afternoon. This session is being recorded, and the recording will be sent via a link to all registrants later this week via email. With that said, I am pleased to introduce my colleagues and our presenters this afternoon, Mario, Brandon, and Garrett. Mario, Brandon, and Garrett are all part of the SRP WEllth team, which is an extension of our retirement plan business that focuses on financial planning and investment management solutions for individuals, couples, and families. We recognize that your workplace retirement plan may be only one piece of your financial life, and Mario, Brandon, and Garrett really specialize in bringing together all the pieces of your financial life into one plan that is specific to your goals and your needs. So speaking of goals, the goal for today's presentation is to introduce some basic financial planning concepts and give you some tools so that you can get started on a more informed financial planning journey yourself. So thank you all for being here. Thank you to my colleagues, our presenters, and I'm going to have Garrett take it away.
Well, thank you. Thank you so much, Sarah. I'm really excited to be able to speak with you all today. There's a lot of ground to cover, even with an overview. But here are the topics that we're going to be touching on, and we've broken them into really 4 pillars that you can think about. The first is building. So we'll talk about setting goals, which is really the first step and the foundation towards developing any type of financial plan. We'll discuss creating a budget and setting aside an emergency fund, as well as discuss the need to incorporate credit into your financial plan. So we'll discuss some credit fundamentals as well. The next pillar we'll talk about is managing, which is managing what you already have. So we'll talk about some basic investment concepts, understanding some taxes, which will help you pursue your goals, which might include saving for college and planning for retirement. Third, we'll talk about preserving. So we'll touch on some insurance protection and some types of different types of insurance you might need. And finally, transitioning, which is our last pillar, where we'll look at some basics of estate planning. So again, there's a lot to cover, so let's get started. So first thing I actually want to do is just to get everybody involved. And to start off, I want to ask, from an overview level, do you know where you stand financially? So maybe you have some information on paper, maybe it's in a spreadsheet, but do you have a general idea of where you are today? So take a moment to think about that and respond in our poll. Okay, so some answers filling in here. So, so kind of it's a little bit of a mix, but a lot of you responded yes, which is great. Hopefully we'll still be able to provide some value and maybe talk about some things maybe you haven't thought about. And as a follow-up to that question, the next question I want to ask is, have you ever done any type of personal financial planning? So maybe you've met with a financial advisor, maybe you have, an online solution that's helping you keep track of your money, but have you ever met with some type of third party to discuss your personal finances? Okay, so it's kind of updating real time. I'm seeing an even split, which is really interesting. They're a little bit towards yes, but still an even split. So thank you all for participating. Regardless, again, I'm hoping all of us should be able to give you something that should give you a nice takeaway from today, regardless if you have or not. So as I mentioned before, the first pillar of financial planning is what we call building. And this really deals with kind of more foundational topics that are going to be really important to have in place for what Mario and for what Brandon are going to talk about a little bit later. And building very much deals with the basics of financial planning, and these may be some topics that you haven't thought about in years, but these are still really important to have in place, again, before moving on to the advanced topics. So bear with me, I just want to take a little bit of time to talk about them. When it comes to financial planning, I just want to give you guys a high-level outline of how that process works. And really, this is what you should be looking for in whatever solution you choose for your personal situation. The first step is to align whatever product or service you're choosing to help you with your own personal financial goals. The next is to design a plan that addresses those goals. And then finally, you need to have some type of plan of action, right, that helps you actually pursue those goals. So, as I mentioned, really the first step in financial planning is setting goals and really think about what it is you want for your future. So some of your goals may be things that you want to do soon, like paying off credit card debt or buying a new car, while others may be more distant. Maybe you want to buy or build a new home, start your own business, pay for your college or your child's college or your grandchild's college, or maybe you just want to retire early because you're tired of working. Whatever your personal goals are, your goals are the foundation of your financial plan because you need to know what you want to accomplish before you can begin saving or investing. And once you've identified and prioritized your financial goals, you can then develop a clear-cut savings or investment strategy that can help you turn those dreams into reality. Okay, so and kind of continuing the conversation about goals, I want to kind of ask the audience again, what is most important to you in your financial life? And again, there's no right or wrong answers here. Just we kind of listed some of the things that we often see just in our experience, but maybe it's traveling and seeing the world. Maybe it's spending more time with, family and friends. Maybe it's leaving a legacy, supporting charity, helping your loved ones, or just wanting an overall a greater amount of financial stability. So think about it. Obviously, again, no right or wrong answers, but please participate. Okay, so wow, I mean, there's a lot of kind of, as we imagine, all over the board, right? And hopefully, as I said, no right or wrong answers. Hopefully what we talk about today will help you in some way, maybe get a little bit closer to that. Okay, so now that we've talked about and thought about our dreams and aspirations, let's talk about everyone's favorite topic, which is budgeting. It's definitely not a very popular topic, but the first part of putting any financial plan into action is controlling the flow of your money. And that's really what a budget is all about. A budget helps you track your income and your expenses, and then it helps you direct your money in the way you want it to go. So the first step is in constructing a budget is really just to account for all of your income, whether it's from your salary that you get, maybe every week, every other week, or from any other sources you're getting money from, right? And then after that, you subtract your expenses. And expenses can be broken down into two categories, both fixed expenses and discretionary expenses. And fixed expenses you can think of are those things you pretty much have to pay for. So things like rent, your mortgage, your car payments, your insurance premiums, utilities, things of that nature. Discretionary expenses are the more fun things, such as dining out, traveling, vacations. Now, after looking at all the money coming in and all the money going out, the big question you want to ask yourself is there money left over? If the answer is yes, that's great. You're running a surplus. And then we return our attention back to those goals we just talked about and determine which of those goals do you want to divert the extra money to. On the other hand, if you don't have extra money left over, you'd be running a deficit. And then that would be something that would need to be addressed. And really, there's two sides of that equation, really. Either you would need to make more money or you need to lower your expenses. And ideally, you may want to look at doing both. But again, for today, we're kind of operating at an overview level. So for the purposes of our conversation today, we're going to look on the bright side and assume you are running a surplus. And one of the very first things you might want to look at with a surplus is starting an emergency fund. And an emergency fund is really important because life happens and unexpected expenses are going to come up. But if you have an emergency fund, it'll be much easier to handle those setbacks that might prevent you from working towards those goals we talked about. One of the big questions we get just in our field is how much should you have in an emergency fund? And, a popular rule of thumb is that you should have an emergency fund equal to 3 to 6 months of your living expenses. Keep in mind, this is a rubric, it's a guide, it's not perfect. It should always be considered in, the context of your own personal circumstances. But having said that, I do just want to give you guys, a starting point of what's generally considered an adequate amount. So if you're a single income household, you need to be leaning more towards that 6 months mark. If you're a dual income household, maybe you could rely closer to 3, but again, always in the context of your personal situation. If you are retired and you're no longer working, so you're no longer getting a paycheck, you probably should consider going above and beyond the 3 to 6 month range and really looking to shore up about a year's worth of expenses. So those are just some points to consider. Alongside how much to have, where you keep those is really important. And you want to keep in mind here liquidity and being able to access that readily. So really the best place is pretty simple, just in a savings account, either in, a local bank or, even a bank online, if you're comfortable with that. Okay, so, so you've established emergency fund, you've planned a budget, but sometimes you need more money, right? And that's where credit comes in. Just kind of a word of caution here, though. Don't rely on credit to cover your normal living expenses. If you do, you could be heading down a kind of a dangerous path. And if you are using credit to pay for normal living expenses, it's because it should be convenient to do so, or maybe you get some cash back, from like a credit card, but it's not because you don't have those expenses planned for. That's really important. But, again, when it comes to financing those big ticket items in our lives, again, college, home, maybe a car, some of us will need some type of loan, right? And I would say most of us probably will. And as planners, one of the common questions we get is about debt. And different people will have a wide variety of different views on debt. And as planners, we can't just give blanket advice because not all debt is bad debt. And again, common theme, everyone's situation is going to be different. Having said that, when you are considering taking on any additional debt, it's always worthwhile to pay attention to the interest rate on that debt. Some rates on loans such as a mortgage are going to be much less harsh than interest maybe on a credit card. Also keep in mind opportunity cost. There is a cost to, like in a buying versus leasing scenario, there's going to be a cost to buying something outright. There's also going to be a cost to leasing something and having payments. So again, it's just really important to take those bigger ticket buying decisions slowly so you can be most informed to all of your options. And finally, one last point I just wanted to touch on is your credit score, because it does kind of get a lot of hype. A credit score, by and large, analyzes the information on your credit report, compares your profile to thousands of other similar profiles, and then produces, that 3-digit number we're pretty familiar with. And that just tells you your credit risk to credit lenders. So again, it is definitely something to keep an eye on as you evaluate your finances, and just as something to keep a general eye on. And with that, so that wraps up building. And with that, I'm going to turn it over to Mario, who's going to dig a little bit deeper into some more advanced topics. So Mario.
Perfect. Thanks, Garrett. I appreciate it. And then again, everyone, thank you for taking the time to join us today on this webinar. To Garrett's point, really what he was covering is just really the high level foot view, looking at a 10,000 foot view, just, okay, what are the basic concepts here? And really the key driver there is what is important to you? What are your values? Because every one of us, we're all different in what's important to us. We all have different goals. We all have different timelines. But effectively, once we figure out what those values and goals are, the next question is, okay, what's the action plan? How do we manage towards that? And really, before I dive into that, one of the questions I tend to ask a lot of clients that we work with is just kind of getting to understand ourselves first. And the key question here, it's when it comes to management and looking at the action plan, when you look at your specific risk tolerance when it comes to a portfolio, how do you see yourself? Are you someone that's very risky, that you're okay taking the ups and downs? Are you someone that's on the opposite end? Maybe you're very conservative and you really want to protect what you've built. Or are you someone in the middle and just not sure, or quite frankly, you just don't know? So I'm seeing answers come in here. And again, what I'm seeing in the middle here, it's not too risky, but not too conservative. A comment I get a lot, but even so, there's 8% of you who say not sure. And that's okay. And that's what we're here for. Because effectively, the next part of the question here comes down to, when you look at one, you identify your risk tolerance. Again, you say someone that's in the middle. Then when you look underneath the hood at how you're actually managing towards those goals, are they aligned with your risk tolerance? Let me see the answers coming in here. A lot of you are saying yes. So far, it's one response. Now it's adding up. So yeah, we're getting that yes, about 67%. A lot of you are not sure. And quite frankly, what we tend to see a lot, it's that not sure. It's, you say you're someone that's very conservative, but then we start looking at, okay, how are we looking at the portfolio? And you might be on the completely other end of that allocation, which might be okay looking backwards, but then looking forward, really just making sure we're addressing those changes and those values. Because when it comes to management and the action plan, really we tend to focus on three parts when it comes to the portfolio. A lot of terms you might see here, maybe they're new, but maybe a lot of them are old. It's things like growth, income, and stability. And for a lot of us, all three of these terms that you see here will interact with our portfolios or our lives over time. So the goal here is just evolving, being able to adapt and change over time as your circumstances change. For example, the first phase here is growth. And what we mean by growth is effectively growing or the capital appreciation. So someone who might be in this aspect might be someone who might be younger, whether they know their timeline's a lot further out than someone who's maybe in their 60s or 70s, where they're looking to grow or maximize their portfolio over time. Another one might be income. So again, as Garrett mentioned, as you get closer to that retirement date and that paycheck stops, your focus shifts from growing a portfolio to now living off of it. So what is that income that you're going to get from that portfolio? Or maybe it's other sources too. And then stability. So protecting what you've accumulated. And at the end of the day, again, all of these work together. There's no right or wrong solution. It's specific to who you are as an individual. And these are some of the things that we can control in our financial lives. But I tend to say a lot, and we tend to say a lot, it's you only have control over so many things in your lives, especially when it comes to investing and managing towards those goals. And we always say it's control what you can control. And what that means is, one, what is the plan? What are the values that you're targeting? What is it that's important to you? Next is, okay, once we figure out what those values and goals are, how do we diversify ourselves, both from a portfolio, but also from a tax perspective, which I'll dive into a little bit here as well. But making sure that you're not just concentrated on one aspect of both the portfolio as well as a tax picture here. But even so, a lot of us on this webinar are either participants or employees within retirement plans where we're adding to our portfolio over time, which is called dollar cost averaging, meaning you're buying into the ups and downs over time, taking advantage of that. You're not just dumping everything in at once. And then the last piece here, which I personally think is overlooked the most, it's asset placements. And effectively what that means is being tax efficient with your portfolio. And what we mean by tax efficiency, it's, I mentioned before, you want to be diversified from an investment standpoint, but you also want to be diversified from a tax standpoint in terms of how your assets work for you. And one of the things that I tend to show a lot of clients we work with is just our basic bucket system here, where for most people in their financial lives, they tend to have access to these three various investment buckets. Most of us know what a 401k or an IRA is. But maybe some of us have access to something like a Roth IRA, which allows for tax-free growth, but then tax-free distributions in the future. Or for some of us, we might have some excess cash flow, which Garrett brought up. Maybe there's a surplus when you have your income and your expenses, where you say, hey, I want to save more than what I can save in my retirement plan. Okay, maybe you allocate some of your resources to something like a taxable account, which acts like an ultra savings account where you can invest those funds for liquidity, but it's going to earn you more over time than what it's going to do in cash. But at the end of the day, all three buckets, they wrap up to the total portfolio, but they are very different from a tax perspective in terms of what you keep. It's not about what you earn, it's what you keep after those earnings. And a lot of questions we get on, especially as you get more into the weeds of personal financial planning, it's really understanding taxes and how they affect you both at a federal level and a state level. Because really, when you look here, the three main things that we look at is when it comes to your savings, at least from a portfolio perspective, there are things like pre-tax, like a 401k, versus things like a Roth, which is after tax, but it provides tax-free growth as well as tax-free distributions. Then in the middle here, which gets very confusing, are things like income taxes, both from an ordinary income taxes, so taxes that you pay in your paycheck, versus capital gains, which is a tax, but it's very different and tends to be more favorable when it comes to tax planning. And then lastly, here in the white, it's just really understanding how marginal tax brackets work, especially when it comes to tax planning for those people who might be entering retirement, where for a majority of your lives, you've been in a high income tax bracket or a higher income tax bracket than you might be, say, 65 onward, where that income stops and really all you're living off of are things like Social Security. You're living off the portfolio income. Maybe you have some other savings that you're living off of too, but your tax system is very different. And I won't go too much in the weeds here, but effectively one thing that we look at a lot when it comes to tax planning from a portfolio and managing towards those goals is where are you? Where are you starting and where are you going to be potentially in the future? Because understanding how tax brackets work really impacts a cash flow as well as the portfolio. Because, for example, we look at someone who's single here or married filing jointly here, just a minor change in your income from these two brackets, you go from 12%, at least from the federal level, to 22%. And then it's marginal too. So as your income goes up, the tax rate goes up along with it. You're paying additional tax on those additional dollars. So looking at where you fall in this tax system really helps you, again, it's not what you earn, it's what you keep, and maximize those opportunities for you. And then even so, outside of that, a lot of people, when it comes to managing their values and their goals, I mean, for some of us who have children, one of the big expenses we're going to have outside of buying a home is paying for college. And how are you going to do that? So there are vehicles out there that we tend to recommend, but really the key cornerstone here, it's the 529 college savings plan, where effectively it's an account that allows you to pay for higher education expenses, but more notably, it provides an account for you to invest into where the monies that go in that account are you can invest where they grow tax-free, but then the distributions, if used for qualified education expenses, come out tax-free too. So for someone who's younger, who just might have had a child or has a young child who's looking to cover that higher expense over time, these can be very powerful tools. And then even so, I'm based in Chicago. So in Illinois, at least, there's a 529 plan here in the state that provides you with an in-state tax deduction too for that benefit. Not every state does that, but there are some that do. So understanding how your 529 system works within your state, it can be a powerful planning tool over time as well. So to really wrap it up on my end here, the one thing I want to talk about, it's when it comes to basically the considerations that Garrett brought up and then everything we talked to about with the taxes and the investments, it all comes down to you at the end of the day as the individual and the family. What kind of retirement do you want to live? What kind of retirement is important to you? I know we had that poll system on looking, okay, what's important to you now? Maybe it's travel, maybe it's helping and leaving a legacy, maybe it's just creating that stability in your life might be important to you. But again, that changes over time. And then really the big picture in the middle here is when do you want to retire? What is that timeline? What should you be thinking about now, maybe in your 20s versus in your 40s, 50s, and 60s? Because again, it's always changing. And then lastly, in the far right, it's how long is retirement going to be? I mean, we're living longer as people thanks to the advances of modern medicine. So making sure that we're having a portfolio, managing a portfolio that can keep up with that longevity. So I know that was a lot. We'll definitely have a Q&A at the end, but really, once we figure out, okay, what do we manage to, the next conversation goes to, okay, how do we start preserving what we have accumulated, and also looking at the estate and legacy planning. And in that part, I'm going to turn it over to my colleague, Brandon, for him to take over here. Brandon, you're on mute.
Thanks, Mario. Thanks, Garrett. Tons of information here. Hopefully everybody's taking some really good notes, getting some great information. I'm going to take this presentation home, like Mario had mentioned, with preserving and then going into transitioning. So you've really built up this great plan. You're managing it well. Now we have to look at what are your downside and how do you protect yourself, your family, your businesses, and everything else in between. And I'll spend a few moments here with insurance because it's one of the best risk management tools that we have to improve the probability of success in your overall financial plans. Now, there's a couple different types of insurance. There's insurances that we need for one reason or another, and there's some insurances that we may not have thought about. Insurances that you need, they really come down to, auto insurance, homeowners, health insurance. Maybe the state has mandated, maybe a mortgage provider has mandated that you have insurance on a home. It's really interesting to see the different types of insurance that are required from some entity or another. But the one insurance you may not have thought about, and something that's very valuable, is your ability to earn income or your human capital. And sometimes this gets put on the wayside, but there's the insurances that we are going to talk about today that will really impact a financial plan or a financial journey will be life insurance, disability insurance, and long-term care insurance. Now we'll start with life insurance. What is life insurance? Well, it's exactly what it says right in the name there. It is insurance on your life. If you are to pass away, there is a predetermined contract with the insurance company that says they will pay a specific dollar to the specific person upon your death. Now, there's all different types of insurance that you can buy with life insurance, and we'll break it down into two categories. One will be the term insurance, and the second is whole life or permanent insurance. And one thing that we always keep in mind is that life insurance is life insurance first and foremost. That is the main tool to use for protecting against premature passing. Now, you may use these in different ways, like term insurance. It's really affordable. You can have a lot of death benefit protection. And we typically see a lot of term insurance being used for younger families that need, $1 million, maybe $2 million. They don't have a lot to spend on the insurance, but need coverage for 20 or 30 years. On the opposite side, where whole life or permanent insurance comes into play, is maybe you're needing to have insurance to your age 100 or 120 for business reasons, estate taxes, whatever it may be, but it provides a benefit to you later on in life when you may need it the most. So life insurance, and we always come back to, what is that exact amount? And I will say, when we show up at a doorstep with a life insurance check, that check is never big enough. And about 95% of Americans are underinsured by a huge amount. So that specific number is to your situation. There's no right or wrong to any number that you have, but what fits your financial journey. So life insurance, it's one of the most common ways to protect against the worst case scenario, but it's actually disability insurance. Disability, in the U.S., 1 in 4 people throughout their working careers will actually become disabled. So what is disability insurance? Well, it's your ability to take an income if you're injured. So I'll use the example. You're on a bike ride and you unfortunately get hit by that school bus that's going down the street every morning. Really unfortunate. Now you can't walk. And there's different types of coverages that may come into play, and I'll speak to group coverages. Most of you may have some sort of group coverage, either short-term or long-term disability through your employer. And I'll speak to the tune of long-term because this is where it really affects an overall financial plan. If you were injured today, your most valuable asset is still more than likely your ability to earn income. Now, with group disability policies, generally speaking, they kick in after 90 days and they'll pay you 60% of the income you were earning before. Sometimes they're pre-tax and sometimes they are non-taxable. It really depends on the coverage. But what's really concerning is, okay, if we drop from, say, $100,000 income to $60,000 income, and now I don't have my retirement savings, my student loans aren't paid for, my health insurance, all those things. That's why disability insurance is really important. And as you start to look at disability coverage, you can go out and pursue your own coverage with different types of carriers. And it's really based upon your needs. And we really like to look at, the different types of your income, what's your occupation, how long do you need coverage? And I'll stick to the own occupation here. This is a really drive home the point to where we had a client a few years ago, anesthesiologist, got injured, could no longer do his job, but could be a primary physician. And as some of us know, the wage disparity is rather large. Because of having a policy that says if you cannot actually go through and do your specific job, we will pay the benefit out even though you can work. So again, 1 in 4 Americans will use some sort of disability coverage at some point in time. In some financial plans, it makes sense to have some sort of supplemental coverage that goes along with it. Now, I know there's a lot of people on the phone that are like, well, I could probably retire today, or maybe we're only a couple years out from retirement. You know, if it happens, it happens. Well, now your insurability, you know, and you start looking at what other values and what are priorities I start to have. And this transitions into long-term care plan. And I don't want to segment this in just the people that are nearing retirement. Everyone on this phone can take away something from this to help the generation that you may have to care for, or grandparents or relatives. And with long-term care planning, really we're looking at if someone cannot do 2 of the 6 activities of daily living, so bathing, toileting, showering, transferring, eating, signing the name at the end of the day, and they need some sort of help. And that help could be from in-home daycare or in-home nurse, going to adult daycare facility, assisted living, memory care. It all falls into the same category. But if you haven't made a plan, you fall into the self-insuring category. And maybe you have made a plan and this is where you fall into. And it's the most common type, but not necessarily the right type of plan to go for your situation. And with self-insuring, you're really playing the odds that you will not need some sort of care in the future. So you're taking on 100% of the risk, and it's the least costly to you right now. So you don't have to buy an insurance policy, but if you ever need care, it's coming right from your savings. And now where we look at this from a planning perspective is what happens to your surviving spouse. If you have to spend down your money to, you know, Minnesota, it's about $75,000, a car, your primary residence, there's not anything left for your spouse to live on. So traditionally, when we looked at different types of plans, the only plan out there to insure was traditional long-term care insurance. And this is pretty common with the generation that's receiving care now, or you know, in their 70s at this point in time. But it was their only option. You got a really robust policy. I call it the Cadillac type of plan. But the problem is that they're costly, and if you don't use the benefit, which is great in that sense, you lose everything you put into it. So we've really come to an arrangement within the industry that these hybrid types of policies, whether it's life insurance or annuity, to where you buy a policy that will pay out long-term care benefits, and it's pre-designed, whether it's $3,000, $5,000, $20,000. And sometimes they pay for 3 years, sometimes they pay for an unlimited period of time. But the key differentiator here is that you have coverage, and if you never use that benefit, you can always, that death benefit will go to your beneficiaries income tax-free. So there's no right or wrong here. I want everybody to hear that. It is a personal choice how you decide on what type of long-term care plan you have, but sometimes the numbers make sense to pursue a different avenue than another. So as long as we're on this topic of more of the end-of-life planning, I want to talk more about transitioning. And this is something that I'm personally going through right now with a family member of not having a complete estate plan. So it's an important topic that everyone needs to focus on, and everybody should be able to take away something from transitioning. And I'm not talking about transitioning from retirement or from working years to retirement. This is truly at the end of the day, and you pass away, what happens? And with estate planning, there's really 4 objectives that we can look at. One is efficient distribution, getting the money from your accounts to the proper person. Avoiding probate, and I say at all costs, minimizing estate tax, and planning for incapacity. So most of our clients like a simple approach to the overall estate plan, and some need a little more complexity, so we'll talk more in the simple manner here. Beneficiaries, registrations, transfer on deaths, and payable on deaths are all different types of beneficiary designations you can put on financial accounts. They will supersede any will or trust that you may have. If you no longer if you do not have any of these types of beneficiaries or registrations, your will would then take place to help direct the courts to distribute your assets. If you have a trust, great. That document will directly tell your trustee and your executor where the money needs to go. So just with those few things, it really helps simplify the overall estate planning process and administration if you're no longer here. Minimizing estate taxes. I'm just going to say a quick thing on this. If your estate, if you're single, is over $12 million between businesses, investment accounts, life insurance, your properties, or married over $24 million, you're going to have federal estate tax problems. In certain other states, those limits are much lower, and you may need to look at the state level as well. And there's different tools out there that are very specific to your situation. And number 4, I think this is the most important because it can be the most time-consuming part in the worst times possible. Having a power of an attorney and having a healthcare directive. I cannot stress this enough. If you do not have these, you get hit by that bus on your bike and you can no longer make decisions for yourself. If you have these documents, you have the choice to direct someone to make those decisions for you financially and for your healthcare based on your wishes. If you do not have these documents, that person needs to petition to the courts to have that issued at a very dire time. So if you can take away one thing from here, this is a scary subject, but I hope I make it a little bit easier to understand what you really need to go and do. Attorneys are a great help. If you have LegalZoom, Legal Shield, all of those services can get you your basic documents like your wills, your power of attorneys, and healthcare directives. What we do not provide the legal advice, but we help ensure that you take action to have everything listed properly, the beneficiaries, the trust, the wills, and have your estate flow correctly. So we just threw a whole lot at you. I'm sure your sponges are completely full. What should you be thinking about? And that's a great question. And everyone here can start today because now is the time to start. And just create that game plan. And that game plan can be created through your advisor, through a professional, through any application, through an Excel spreadsheet, or just writing it down on paper. But it's getting your goals, values, and priorities down. You then start to map out the overall cash flow. Can you actually achieve your goals and your desires? If you can't, what improvements do you need to make? And then at the end of the day, once you have your plan down pat saying, I can retire, I can do all these things, what is the probability that I will be successful? And educate yourself around, here's the best case if markets are doing really great every single year, and here's the worst case based on my timing. So things everyone can be doing, even if you're 20 years out from retirement, if you're 6 months out from retirement, there are always things that can be done and ways to educate yourself to ensure you're making those proper decisions. Now I'm going to turn this back over to Mario to finish this off and really move forward with some actionable items that everyone on this phone call can take.
Yeah, so thanks, Brandon. And to his point, really, it all starts with what's that game plan. And as Sarah brought up at the beginning of this call, this webinar, we wanted to provide you all with some resources so that you can start looking at your personal financial plan and what you should be doing. So on this QR code, if you scan it with your phone, it goes right to our website where it gives you that organizer, where it helps you get just the basic information down so that you can start thinking about, okay, what should I be thinking about? What is the income? What are the expenses? What are the goals? What are the things that I should be keeping in front of hand in terms of, okay, those estate planning documents Brandon brought up, tax returns, making sure you understand your tax situation, the other insurance documents, but also, things like bank accounts and making sure you have enough in savings, as Garrett brought up in terms of a liquidity reserve. So if you scan this code, again, it goes to our website where it helps you with that organizer as well as that checklist. But even so, our group, SRP Wealth, if there's something during this conversation that you said, hey, you know what, this clicks with me, I really want to dive into this more, that's why Wealth was created within SRP. It's there to be that extension outside of the 401k retirement plan, where we can help you across all aspects of anyone's life. Really, for anybody, let's look at the accumulation phase. So someone in their early 20s, 30s, where maybe their main focus might be, you know what, I'm having a family. How do I start saving for college? I should start looking at a will or power of attorney, getting those basic documents in place. Or the transition phase. At least someone in their 50s or 60s saying, I'm looking to retire the next several years. What is that game plan? What should I be thinking about? What should I be doing differently up until that point? And then the decumulation phase, it's okay. That income is stopping, as Garrett mentioned before. What do I start living off of? What is that income? What is that tax strategy? What is that income replacement? And then eventually, as to Brandon's last point, is the transition or the estate planning. Really thinking about that legacy and what is it that you want to leave behind. So again, there's a lot of information that we covered on this topic here. That first QR code just gave you the basic organizers that you can start looking at your personal financial planning picture here. But if you have any specific questions or anything that you need more information on, again, this is our QR code, which goes to our bookings app, where you can schedule one-on-one with one of us and really go into your specific situation. And we can help answer those questions too. So.
Outstanding. And thank you, Mario, Brandon, and Garrett for sharing such valuable information. We encourage everyone on the phone to take advantage of that data organizer. Honestly, if you were to meet with a financial planner or meet with a member of the WEllth team, one of the first things that they would encourage you to do would be to come forward and gather all that information together. So even though it doesn't sound like a fun thing to have on your to-do list, it can be a real useful exercise if you're looking to, take that next step in your financial journey. I wanted to bring back our presenters for some Q&A here and get Brandon first on some questions that rolled in specifically related to long-term care, and I knew they would. One of the first questions, Brandon, was where would I procure or where would I get long-term care insurance, and at what age really would you recommend starting to take on those premiums?
Easy answer is we can absolutely help you out with that. So if you're looking for quotes on how much that costs, we can help you there. So we work with a numerous number of carriers. We're independent in that regard. In terms of age, when we start looking at long-term care policies, there's always a sweet spot, and there's never a case to where it's never too early. So if it's something that you really want, you can always get earlier. But that sweet spot is really, if you're healthy, that is the big determining factor here. You always have to be in good health. Is in your mid to late 50s is generally that sweet spot to look at long-term care coverage. And I say that because you're not putting forward so much premium for 20 or 30 years when you may not even need it for the next 50 or 60 years. It's really honing in on that sweet spot to where you're healthy, you have the assets to pay for it, you've accomplished your other goals, and you know that this is a definite need. So, in your 50s is a good place to start.
And then, Brandon, I know it's impossible to give pricing, but when you say less expensive or most expensive, are you able to share a range for what a policy might cost? I know there's so many nuances there.
I'm glad this question came up because it's surprising. So the self-insuring route can be the least expensive by $0 if you never need care. In the traditional types of policies, just keeping everything generic, a standard healthy 60-year-old couple here in Minnesota, a standard policy was ranging anywhere from like $7,000 to $20,000 a year. Now, the problem that we're experiencing here in the state of Minnesota is that the insurance carriers didn't charge enough premiums for the people that are receiving benefits at this point in time. So we're seeing a continual increase every single year. And right now in Minnesota, they're already out 3 years, and they're going back to petition for another 3 years, and your premiums continue to rise. Now, in the terms of a hybrid type of arrangement, that really varies. You can pay that all up front, or you can pay that monthly. And it really is based on the benefits you need and whether you're insuring just yourself or you and your spouse in the same policy. But generally speaking, they are much less, not saying that they're 25% of the cost. They're, around 60 to 70%, give or take, for that hybrid type of coverage than a traditional policy. And again, coming back to what coverages you need will be the big determining factor what that premium looks like.
Perfect. Thank you so much, Brandon. There are a couple questions coming in that are very quick, easy answers, so I'm going to hit those ones right away. First, are you a fiduciary? And the answer to that is yes. SRP acts in a fiduciary capacity on the retirement plans that we serve and for our retirement plan participants, and also on the WEllth side when we're working with individuals, couples, and families. So what that word really means is that we are charged and mandated to act in the best interest of you, the client, as opposed to, whatever might be serving us from a revenue standpoint. So we are independent advisors, and the only thing that we're paid for is advice, and we do not earn any commissions on products that we sell. So quick answer for that. How much does a consult cost? It's a free consultation. So if you want to talk to a member of the WEllth team for 30 minutes, kind of bring some ideas forward and share your situation, get our take on that, we are happy to schedule time with you. And that is part of what we do. So please feel free to reach out. That's a no charge situation. Let's see. There are a couple investment related questions that came through and tax questions. So I think I'll charge Mario with those. First, from Sandy, what kind of taxes will you pay if you convert a traditional 401k to a Roth? Roth
Yes.
conversions are a popular topic.
Yeah, so if that's Sandy, thanks for the question. When it comes to the word Sarah brought up, a Roth conversion of going from pre-tax dollars to a Roth IRA, the tax that you'd be paying is ordinary income on those dollars. So it's looking at, again, I brought up the tax table, maybe in retirements where, again, maybe you're in your 50s or 60s now, your income is higher. It might not be the best idea to do a Roth conversion now, but maybe in your late 60s where that income stops, you might be in a very different tax bracket from a federal and state level. So maybe it makes sense to do partial conversions each year. And that's something that, again, it's specific to each individual, but to your question and the answer, it's ordinary income from a federal level, which is taxed more than I saw a questionnaire in capital gains. And the difference there, ordinary income, I'll go back on the slide here. Ordinary income, think of it as the income that you pay in your paychecks every 2 weeks, where it's based on this federal level here. So ordinary income can range anywhere from 10% all the way up to 37%. And then you might have some state income on top of this. But capital gains, there's short-term and long-term. When short-term capital gains, meaning you've held an investment in a non-retirement account. So that's the taxable account, the trust, the individual brokerage, more than 1 year. If you hold it more than 1 year, that long-term capital gain is 15% or 20% of your income is higher, versus short-term capital gain, which is if you bought it and held it less than 1 year, then you pay ordinary income on that at these rates here. So again, it just goes back to knowing how the tax system works, knowing the brackets, because it's not about what you earn, but what you keep.
Perfect, Mario. Thank you. There was a 529 question that came in specific to California, but I think that others might be interested in that as well. Do you have any comments related to 529s for low-income families or first-generation students? Are there any disadvantages or drawbacks that may complicate a potential financial aid package if you do use that 529 vehicle?
Yeah,
Any thoughts on that?
Each 529 is specific to the state, because I think California, don't quote me on this, I think it's one of the states that does not provide a tax deduction. So really you're just shopping around for what's the lowest cost to get in terms of the investment elections and what's available out there. But effectively, I mean, in Illinois, you can start a 529 with as little as $100. So again, it's specific to the plan itself, but there's no minimum that you must have $5,000 at one time. In terms of the accessibility, again, it's pretty easy to set up. But the thing to consider from a financial aid perspective is who should own the 529 account. And when I say that is for most people, when they open up a 529, it's usually a parent opening up the 529 for their child, where the 529 from a FAFSA perspective is included as an asset on the form as the parent. So I think it's up to 5% of the value is included within that FAFSA calculation. So that can decentivize in terms of some student aid getting awarded to your child. Versus if a grandparent own a 529 for the benefit of the grandchild, that's not an asset that's part of the calculation. But then there's some other things, and I'm getting the weeds here, where if any distributions are made from the 529 from the grandparent owned 529, that can be considered income to the child. So it's just looking at those little quirky things. But for most things, it's roughly 5% of the parent owned. That's really the biggest factor from a FAFSA financial aid perspective.
Great, thanks, Mario. This question kind of takes the current market conditions into consideration, and I would put it out to any one of you. Based on the blip in inflation, are planners reassessing what the long-term growth rate will be in a retirement portfolio? We've gotten real comfortable using somewhere between 6 and 8%. Has that changed, and what are you doing with your clients to that end?
Yeah, so I bring up this slide again, and I'm sorry I'm dominating the conversation here, but really it's control what you can control. And you're right. I mean, this environment is unique. We have inflation that's really taking away purchasing power. We have a federal government too that's kind of reacting to the current environment, which is impacting certain investments. So really, when you look at what we use as planners, I mean, I think that 6% is a little high right now, especially when it comes to projections. We tend to be more conservative in terms of what we use for rate of return, and it's around the 5% rate. But again, it's not about what you earn, it's about what you keep. So you have to look at what's the tax consequences, what's the inflation, what's it taking away from you. So when it comes to projections, I always lean on the side of being more conservative on the rate of return, the more aggressive there, even on the more aggressive investments too.
Very good. Kathleen asked a question that, if you guys don't mind, I can take. She says, all retirement calculators confuse me regarding how they are calculated. Some are evaluating current dollars, some are future, some tell me I'm beautifully on track, while others say I'm not. It is somewhat confusing. Most of you are participating in a workplace retirement plan and likely have access to a retirement calculator on your record keeper website, be it Fidelity or Principal or Empower. And those are sometimes a good place to start, but it's really important to read the assumptions that are being used in those calculators. Some are using future dollars, some are using current dollars, some are using an income replacement rate of 85%, whereas another one might be using 70% as a baseline. So the information that it puts out to you is really only as good as the information that you're able to feed into that engine. Over the years at SRP, we have built our own retirement income calculator because we wanted to get comfortable with the assumptions. We wanted to use our own methodology. And so if that's not something you've experienced in the past, we'd be happy to show that to you and walk you through it. And it's another reason why the consistency of working with a financial planner who knows your assumptions, knows your goals, knows your risk tolerance, and you can keep coming back to that same calculator and refining it over time. That can just be another valuable benefit of establishing that relationship so that you're not getting conflicting opinions all over the place.
And I'm going to add to that, Sarah. It's very important to stick with your trusted advisors and make sure that your trusted advisors are communicating. Your accountant, your P&C agent, your commercial agent, your attorney, helping that communication along the way with your financial advisor professional ensures that you're going to have that coordinated effort for your plan. Make sure that everything is, the T's are crossed and the I's are dotted in that regard.
There was a question in the chat, I'm sure because everyone shared such impressive knowledge today, just about your credentials and pending credentials. Could each of you just share real quick your financial credentials? Brandon, we can start with you.
Yeah, so I'm a retirement income certified professional, accredited investment fiduciary, and a certified plan fiduciary advisor. So a little bit of an alphabet.
Yeah. Mario?
Myself, I'm a certified financial planner as well as a CFA candidate as well.
Great. And Garrett, last but not least.
So I am a pending certified financial planner. I just found out a couple weeks ago that I passed the CFP exam and will be getting those marks by the end of the year. So until then, I'm primarily assisting and supporting both Brandon and Mario.
Excellent. Thank you. Let's see. Very technical, but rather straightforward question from Maggie. When you sell stocks, does it count the oldest share purchased or the most recent?
It depends on what you select from a custodian and when you buy the stock itself. So you can specifically say, hey, when I want to sell this position, I want to sell this specific tax lot. So it's more tax efficient potentially for you to sell that position. Or maybe some custodians, they keep it easy. They just say, hey, we're going to use average cost basis, meaning it'll take all of your buys, combine them into one and say, okay, this is the average cost per share, which makes it easy, but it makes it harder from a tax planning perspective because then you have to figure out, okay, which cost basis is aligned with which lot. So we tend to recommend either, we call it HIFO, high cost in first out, which means we're looking for the highest costing share to sell first to minimize that tax impact. But you can do anything. You can do LIFO, last in, first out, FIFO, first in, first out. It's the whole alphabet you can choose from.
Another reason to maybe work with an expert who can help you navigate that alphabet soup. Brandon, question from Julie. Would you still recommend getting long-term, I'm assuming, care coverage at age 68?
It all depends. It can work. Comes back to health, the dollars, the need, and your priorities. So that is very much so a depends. but very attainable at 68.
Very good. From Corey, do you need to pay for a power of attorney, or can you get the form and fill it out for free? I know you guys mentioned some online resources like a LegalZoom or something like that. So can you speak to that?
Yep. So LegalZoom, LegalShield, there's a bunch of them out there. Some states have a state statute form for some of these documents. Some states do not, but any attorney can help you out there. And it really varies attorney to attorney, location to location. Obviously, an attorney to draft the documents in New York City is going to be more than rural Nebraska. In Minnesota, we generally see for a husband and a wife for their basic estate planning documents, your wills, power attorney, healthcare directives, and maybe a trust, give or take $3,000 as a starting point. But if you just need one specifically, or just a really basic plan, sometimes you can find those forms online or use a LegalZoom you're already signed up for.
Very good. All right, so I think we're coming to the end of our questions. We were able to get to most of them, which delights me. And Mario, if you could just go back to the WEllth consultation QR code as we leave you with a few final comments. For some of you, you prefer not to use a QR code. The link to the data organizer was shared by one of our participants in the Q&A or in the chat, which is awesome. And then if for some reason you're not comfortable with the QR code to reach out to us regarding a consultation, you can always email us at plantoday@srpretire.com. And we will get back to you regarding scheduling a consultation. I put that email address in the chat as well, but maybe someone else could throw it up there for me. plantoday@srpretire.com. So in addition to sending the recording of this presentation out, I will also send links to make sure that you can get to that data organizer and that you can get to our bookings page and stay in touch with the WEllth team should any of these financial planning considerations come up, and should you want more help and guidance from our team here at SRP. So with that said, thank you everyone for joining us today. We certainly appreciate you being here. Please save the date for our next webinar. It is going to be on Tuesday, August 9th, which will likely be here before we know it. We're going to revisit the perennial favorite topic of Roth versus traditional contributions, and the consideration of those in your 401k plan or 403b, but also outside the plan as well with Roth IRAs and things like that. So invitations will be forthcoming. We just encourage you to participate and stick with us on this education journey throughout 2022. So thanks again, everyone, for joining. Appreciate you, Garrett, Mario, and Brandon, for all of your hard work and sharing your knowledge. We hope everyone has a great rest of your day. Thank you again.